We spoke of investments properties. We spoke of owner-occupied property. So now we want to talk about the intangible assets. When we talk of intangible assets, we're talking about assets that doesn't have a physical form. You know, we're saying that this asset, you cannot touch this asset. So in other words, should I use the word invisible? Intangible assets like goodwill, right? That's an asset, but it's an intangible asset. We're talking of rights. You know, you have rights to broadcast 1, 2, 3 thing. You know, those are intangible assets. So it's assets that doesn't have a physical form. So now the part that we deal with is to account for these intangible assets. How are we going to account the intangible asset, right? So remember last week we did the effects in the exchange transaction. In other words, we're saying that when we purchase an asset from another country, how do we account for that asset in our books, right? So now we're going to have an asset that we purchase probably from another country, which becomes probably is an intangible asset. Then we're also going to say, you know what? We can also generate this intangible asset. We can also have our own intangible asset. So when we have our own intangible asset, we are saying that it is an intangible asset that is manufactured within the entity. So now the question to say is that how are we also going to account for that asset that is being manufactured within the entity? From what date, what cost are we going to capitalize, and how much of those costs that are we going to capitalize, right? So we're going to have separate two intangible asset. The other one, we call it a purchased intangible asset. In other words, we are saying that this asset was, when we purchased this asset, it was already ready for use. It was already available for use. Then we say, no, we're also going to generate our own asset. And this asset goes through two phases. It goes through two phases. Okay. Let me just start with the first one. When you have a purchased tangible asset. Okay. So we're going to capitalize it at cost. Capitalize at cost plus any additional cost to bring the asset to a manner required by management. Okay, so we are saying that you can purchase an asset at its cost price, you know, then we're going to capitalize any additional cost that is incurred to bring the asset to a manner that is required by management. I think for a purchased intangible asset, this one is straightforward. This one is clear. It only gets to probably be a bit challenging when we talk about the foreign exchange, to say that the asset was actually purchased from another country. So at what cost are we going to capitalize it? Yeah. Then we have an internally generated tangible asset. We have internally generated intangible asset. We have an internally generated intangible asset. Okay, guys, we're gonna talk about the theory side of this topic at a later stage. We're gonna talk about the theory, the background of these assets at a later stage. But we're also saying that we have an internally generated intangible asset. And this internally generated intangible asset goes through two phases. The first phase is what we call the research phase. So in other words, at this point in time, we are now saying that we are researching to verify if we can actually, and if it's actually feasible for us actually generate this or to manufacture this asset internally. So at this phase, we are incurring costs. So there is a probability that we might go on to manufacture the asset or we might not. So the costs that are incurred at this phase, they are all expensed. In other words, we are saying they are what? They are expenses. You don't capitalize the research cost. All research costs are expensed. So in other words, at the research phase, there is no intangible asset. There is no intangible asset. So at that stage, you are still figuring out within the market to say, okay, is it possible for us to actually manufacture this asset? Do we have the capabilities of developing this asset or to manufacture this asset? Do we have the materials? Do we have the devices? Everything that is needed for us to actually process the systems? We are still on the research phase. Do we have the knowledge, to actually manufacture the intangible, manufacture the intangible asset? Then, guys, the second phase is what we call development phase. Second phase is what we call development phase. The development phase, we are saying that the intangible asset, we have researched, and after the research, we've actually demonstrated that we are now able to generate the asset. Hey, what did I do? We are now able to generate the asset. In other words, we have decided that it is feasible, to complete the asset until it's available for use. So in other words, we are saying that we have already determined that we are able to complete the asset. We are able to develop the asset from today up until it's available for what? For use. We have already made our intention that we want to complete the asset. We need to talk about the intention to complete the asset, either for use or sell. Okay, we are starting to develop the asset. Are we able to complete the asset? Our intention is to say no. We are going to complete the asset. Either we're going to use the asset, or we are going to sell the asset. And we also need to demonstrate that we have the ability to use the asset or sell the asset. We have the ability to use the asset. So in other words, if we are generating a formula, either we're going to sell the formula or we're going to use the formula. Our intention is that we're going to start with the development of the formula, and we are going to use the formula, or we're going to sell the formula, whichever way. Then we go back to the definition of an asset. What is basically an asset? What is an asset, guys? When we say it's an asset, whether intangible or the other asset, what is an asset?
It's a resource controlled by an entity from which future economic benefit is expected to flow into the business.
Exactly. So in other words, we are saying that we need to demonstrate how the asset will generate future economic benefits. Right. So in other words, we are saying that are we able to use the asset or selling the asset? When we say selling the asset, we are saying that is there an existing market that is going to purchase this asset? Do we have clients that are going to buy our product that we're going to generate from this product? So in other words, we are saying that do we have an existing market that is going to purchase the intangible asset after the completion, or after the completion, do we have an existing market that is going to purchase the product that is generated by the what? By the formula. So we also need to talk about the what? We also need to talk about the existing to talk about the existing market. Okay. Okay. And also we need to talk about the availability of adequate technical and financial and other resources to complete the development of the intangible asset. So in other words, when we talk about the adequate technical and financial, do we have enough money? Do we have enough resources? Does it need labor for us to be able to complete the what? To complete the asset, Then lastly, are we able to measure the expenditure? Are we able to measure the expenditure, attributable to the development of the asset? So basically, we are saying that an intangible asset arising from development shall be recognized if and only if, and it can demonstrate. Please take note that they are saying that an asset shall be recognized if an entity is able to demonstrate that all of the below, not half, all of the below. If, in other words, we are saying that for us to be able to say that, okay, we're going to capitalize development cost, we need to meet all of the below. Okay. So when it comes to intangible assets, sometimes they can ask you the theory side of it. That's why we're just talking about it, but they can ask you the theory side of it. So you need to demonstrate all these 6 steps to say, okay, No, it is feasible for us to complete the asset. Our intention, there's no non-intention that we're not going to complete the development of the asset. Are we able to use the asset that we are generating or sell it? How the asset generate the future economic benefits? In other words, here we're talking about of an existing market. You know, why are we generating the? If it's a formula, in this case, we're going to be talking about the formula. Why are we generating the formula? If it's rights that we are whatever that we are doing, why are we doing that? Either we want to sell it, or we have seen that there is a market for this. If we do 1, 2, 3 things, we'll be able to survive. Available of resources, in other words, do we have finances to finance the development of the intangible asset? Then measure, we are saying, are we able to account for each and every cost that is incurred in the development of the intangible asset? Then we put it aside, and at the end of the day, we need to know, when you talk about the measure of the expenditure, guys, we're talking about debts. To say, you are able to demonstrate or to identify from the question to say, you know what, they did the research from this date to this date. And from this date up until this date, they started the development of the formula. So that means the business is able to attribute costs that were incurred from this date to this date. So we are able to measure the expenditure that is attributable to the development of the asset. Because after the research, remember, research happens first. We are researching. Then at the end of the day, we need to have a meeting to say that, okay, we had a research that we want to develop this formula. Now, let's now develop this formula. So you're able to attribute those days to say, you know what, from this day, the search ended, they made a decision. Then from this day, development started. Then all the development costs are capitalized. Development costs are capitalized. In other words, the cost of an intangible asset is the development cost. The cost of an intangible asset is the development cost. In other words, you are now capitalizing all the costs that are incurred during the development phase. Any questions?
No questions.
Okay. So let's go through the question. As we go through the question, let's let's identify the debts, and we need to prepare our note, our intangible asset note. It's more or less the same as the PPE note. We don't calculate depreciation, we calculate amortization. The loss of value of the intangible asset is called amortization. Then we have the intangible asset that have a useful life. In other words, we're saying that it is amortizing over a certain period. Then we have intangible asset that does not have a useful life. In other words, when we look at Nike, Nike in itself is a brand. When can you say that you're going to use it until this day? I don't think it have a useful life that is to say 10 years. We no longer have the asset. No, it still be there. Because it is a brand on its own. When you go and purchase, let's say when we go and purchase rights to broadcast maybe a certain television channel, and you say, no, I want these rights for 10 years. That means you're amortizing it over a period of 10 years, right? Okay. When you go and say, oh, I want a franchise, I want the rights to have my own KFC. And they say, no, yeah, you're gonna operate the KFC. but for this period of time, then that means you are amortizing those rights over that period. Right. So guys, quickly we're just gonna do the purchased one, then we go to the internally generated one. Okay. Because our note needs to have the two assets. It says here that Perfect Paint, Perfect Paint is a paint manufacturing company with a 31 December year end. No. Perfect Paint, so we have a computer software. We have a computer software, which is, I believe it's a purchased, generally generated. Sorry, it's a purchased tangible asset. Perfect Paint purchased the latest computer software for mixing paint from the United States of America. Details of the transactions are as follows. Details of the transactions as follows. Perfect Paint placed an order with the American supplier on 1 January 2012. The invoice price amounted to $10,500, payable as follows: $5,000 on shipment date and the balance of 5.5 on 15 June 2012. The order was shipped free on board on 15 March 2012, and on that date, an amount of 11,500 was paid in cash to the South African Revenue Service for customs and excise duty. On 1 April 2012, the software was installed and available for use as intangible management. Okay. The software is expected to have an estimated useful life of 5 years. The residual value of new was allocated to the software. Amortization is accounted for in accordance with the straight line method over the estimated useful life. Right. The rand was $1 is to 768, 1 January, 15 March 774, 15 June 770. Okay. So let's measure our computer software in according to the dates. We're gonna have the quick journals to account for this. So I'm going to have the intangible asset. Rather, let me just say computer software. SFP. They said that the invoice price amounted to 10,500, payable as follows: 5,000 on shipment date and the balance on 5.5. The order was shipped free on board on 15 March. So this was shipped on 15 March. But on 15 March, we paid a certain amount. And we also have a foreign creditor on the same day. At what exchange rate am I going to measure the asset? At what exchange rate am I going to measure the asset?
15 March.
We're going to measure the asset on what? On 15 March. The order was shipped free on board. So I'm going to say 10,500 times 7.74. Yeah, I'm going to say 10,500 times 7.74. What do I get?
It's 81,270.
81,270. Then bank, I paid 5,000. I'm going to say 5,000 times 7.74. How much do I get?
38,700.
Come again?
38,700.
Then lastly, 5.5 times 7.74. Five point five times 7.74.
42,570.
42,570. Then journal number 2. This is happening 15 March 2012. Then journal number 2, still on 15 March 2012. We have a computer software again in the SFP. Pay 11,500 and credit our bank 11,500. Do we have any question?
Yes, sir.
Yes.
I'm a little bit confused, sir. You said we start processing e-payment after free on board. Yet when I'm looking at that second row, it's talking about Uti. It's gonna be split. The other one will be paid on the 15th of June, the balance. But I'm seeing you have utilized e-rates for the 15th of March. That's where my confusing.
Okay, remember we said that an asset is measured at the rate at FOB. A creditor is measured at the rate at FOB, right? Because we are saying that as we are standing on 15 March, how much are we owing in rand terms? Right, we are owing 42,570. Although we're going to pay it on 15 June 2012, but we are going to check to say from 15 March, since we did not pay, we withhold the payment. Did we made a loss or we made a gain in the movement in the exchange rates, right? But we had to measure the creditor on the date that we got the risk and rewards of the asset, which was 15 March 2012. So what do we do? What do we do first? We measure the asset on the free on board. We measure the liability on the free on board debt. That's what we did. That's number one. Then number two, what I'm going to do now is for me to go to 15 June now, 2012, to say that, okay, since I did not pay on 15 March 2012, 5.5, I withhold the payment for 2 months, March, April, May, June, for 3 months, right? The rate on the date that I got the asset was 7.74. But now because I withhold the payment, it's now 7.70. So now we need to say, did we make a gain or we made a loss in the exchange transaction because of the withhold of the payment that we did? I don't know if I'm making sense.
Yes, you are making sense.
Okay. Who was asking? I'm not sure if it's you.
It was me, sir. Okay, sir.
Okay. So, so the first step that you need to do is to measure the asset. You measure the asset you measure the asset on the free on board debt. You measure the liability on the free on board debt, right? So it means that you are debiting and you are crediting the same rate. Then secondly, you go back. Remember we said, what comes first, payment or year end? In this case, payment comes first. So if payment comes first, any date that comes first, you need to remeasure your creditor. What are we doing? We are saying that on this date, the rate was 7.74, but now the rate is 7.70. What does this mean? It means that my creditor went down. I made a gain because for each and every R1, I was paying, for each and every $1, I was paying R7.74, but now I'm paying R7.70. So that means I gained. So what am I going to do? I'm going to debit the foreign creditor. I'm going to reduce it. Then I'm going to credit my gain on the foreign exchange. In the P&L. 7.74 minus 7.70 times 5. How much do we get?
$220. 220.
It's how much?
220.
220. Then from here, guys, now what do I do? I'm going to say now, on this day, I paid. So I'm going to reduce my liability, foreign creditor, SFP. Then I'm going to say bank, SFP. Then I'm going to say 5.5 times R7.70. How much do we get?
42,350.
42,350. 42,350. Yes. Then, yes.
1st of April, we don't have any transaction.
1st of what?
Of April.
No. On 1st of April, we don't have any transaction.
Aren't we supposed to calculate depreciation?
Depreciation, we don't calculate it on the 1st of April. We'll calculate it on the 31st of December. Because remember, 1st of April, this is the date that it was available for use. So there was no depreciation yet. Rather, there was no amortization. We calculate it at year end. Depreciation, amortization, always at year end. So we come back here, we say, they said the software is expected to have an estimated useful life of 5 years. So I'm going to say amortization P&L, and I'm going to say accumulated amortization. SFP, and I'm going to say 81,270 plus 11,500 divided by 12 times 5, that should give me 60. multiplied by. It was available for use on 1 April 2012. So I have April, I have January, February, March. So times 9 months.
$13,916.
Come again?
13916.
131916.
No, 139.
1916.
1316.
Okay. Okay. Then I'm gonna go to my note. I'm gonna go to my note. I'm gonna go to my note. So I'm going to have the notes, and I'm going to have intangible assets. On my intangible assets, I'm going to have 2 columns. One is for purchased. The other one is for internally generated. Okay. So I'm going to have my carrying amount at the beginning. I'm going to have my cost price. I'm going to have my accumulated amortization. At the beginning. When I skip a line, I'm going to have my additions at cost. Then I'm going to have amortization. And I'm going to have impairment loss. This topic, we're not going to be talking about impairment loss, even if they've impaired. And I skip 2 lines. Skip 2 lines. And I'm going to say carrying amount at end. And I'm going to have cost price. And I'm going to have accumulated amortization. And at end, right? Then here on my purchased one, I'm going to say 81,270 plus 11,500. How much do I get?
$92,770.
92,770.
70.
Then amortization, we say it is 13. 916. Then cost price with 92, 770, 18, 916. So what is the carrying amount at end for the purchased intangible asset?
78859.
78
859.
859.
854, sorry. 4, not 9.
854. All right.
Mm.
Excuse me. So guys, that's my purchased intangible asset. That's my purchased intangible asset. Okay. Then let's go to the internally generated one. This. Okay. All right. They say during the 2012 financial year. During the 2012 financial year, Perfect Paint embarked on a research and development project to develop a formula for an odorless paint. I wanted to do a paint that doesn't smell that bad, if I'm right. Research commenced on 1 February 2012. So they started researching on it on 1 February 2012. One researcher was employed full-time at a salary of 30,000 per month to determine the feasibility of the project. Okay. One researcher was employed full-time at a salary of 30,000 per month to determine the feasibility of the project. This researcher was the only salaried employee working on the project, as it was employed until production commenced. So this person was doing the research. On 1 May 2012, management was presented with sufficient information to indicate that all criteria for recognition of an internally generated intangible asset were met. The development phase of the odorless paint commenced on 1 May 2012. So on this day, all the research was done and met all the criteria. Remember, we spoke about the recognition criteria when we started to say what are these recognition criteria for an internally generated intangible asset that is going to go through the development phase, right? And we say that it needs to meet all of these criteria, right? It has to meet all of them. The moment it misses one, you cannot recognize it. Okay. The development phase of the odorless paint commenced on 1 May 2012 and was completed on 1 October 2012. Production of the paint commenced immediately thereafter. The following directly attributable costs were incurred evenly throughout the research and the development phase. Water and electricity, 8,000 per month. So you need to determine how many months were in the research and how many months were in the development. Depreciation on machinery used for the research and development for the permit amounted to 18,000 for the year. So this depreciation is for the year. So you need now to see how many months did we use it for research and how many months did we use the machinery for development so that you can attribute the cost accordingly. Okay. Depreciation on property, plant, and equipment for the year, excluding the machinery above, amounted to 256,750. So that means the depreciation that is going to be recognized as depreciation in your under your expenses is the depreciation from the 18,000. Going to see how many months were outside the research and the development, then plus 256,750. Following directly attributable personnel costs, excluding above mentioned research, were incurred evenly only during the development phase. So we started paying salaries and wages of 40,000 per month during the development phase. The formula is an estimated useful life of 4 years. No residual value was allocated to the formula. Amortization is accounted for in accordance with the straight line method over the estimated useful life of the formula. On 31 December 2012, there were indicators that the formula could be impaired due to similar product development by a competitor. At that date, based on the market research and using a pre-tax discount rate of 16%, value of the formula was estimated to be 352,000. The fair value was 355,000. So we are saying that, okay, for now, we're going to ignore this this part, which is the impairment. We're gonna do impairment in our next class. So we'll be dealing with our impairment in our next class. Okay, so let's look at research. So we have our internally generated intangible asset. So I'm gonna look at research cost, and we say that this research cost, they are what? They are expensed. Okay, so now we need to determine how many months. So we started our research on 1 February 2012 and it ended on 1 May 2012. So how many months do we have?
4 months.
How many?
4 months, sir.
3 months.
It's February, March, April. So it's actually 3 because May, it was already development. Ne?
Yeah.
Okay.
Then development, we say we have May, June, July, August, September, and October. No, September is not there. Sorry, October is not there. Ne? So we have 5
Yeah.
months. So 3 plus 5, it means that we have 8 months in total. Okay. So let's start attributing our cost. Let's start attributing our cost. We have the salary of the guy who was researching. They said that there was one researcher who was employed full-time at a salary of 30,000 per month. So we had the researcher. And so we're going to say 30,000 times 3.
$90,000.
90,000. So they went on to say that this researcher was the only salaried employee working on the project and was employed until production commenced, of which production commenced on 1 October 2012. So we're going to say it was 30,000 times 3. So now we're going to say 30,000 again times 5.
150,000.
100. Okay. Then also we had water and electricity. So it's 8,000 per month. So I'm going to say 8,000 times 3. 8,000 times 5.
$24,000.
24,000.
40,000.
Come again?
40,000.
40,000. Then we have depreciation for the machine. Depreciation for the machine, we are told that the 18,000 is for the year. So I'm going to say 18,000 divided by 12 times 3. And I say 18,000 divided by 12 times 5.
Research 4,500.
Come again?
4,500 to research.
4,500.
7,500 for development.
7,500. If I add the 2, how much do I get?
12,000.
12,000. So that means here we have 6,000 that needs to go to profit or loss. Okay. Then, lastly, they said the following directly attributable personnel costs were incurred evenly only during the development phase. So we also have salaries, right? But it's 40,000 times 5 for the development phase only. How much do we get?
200,000.
200,000. Okay. Let's add the research, let's add the development.
Research, I have 118,500.
Development,
397,500.
397,500. Then You go back, you say, okay, how much is our amortization? So you're going to say 397,500 divide by. They said that the formula is an estimated useful life of 4 years. Remember, guys, we said that this cost will be expensed, right? But this one will be capitalized, so that when you measure your formula, you're only taking the development cost. The research costs are capitalized. Okay, so 497,500, 4 times 12, 4 years times 12,
48.
48. How many months did we use it in the current financial year?
From October. October.
October, November, December. So with 3 months, right?
Yes, 3 months.
How much do we get?
24,844.
24,000?
844.
844. Hey guys, remember we did not do the impairment loss, right? So we're just gonna recognize it in this way. So we come here, guys, we say our internally generated intangible asset, the addition 397 500. Amortization is 24,844. Didn't do the impairment loss, not yet. And we say 397 500. And we say 24,844. How much do I get if I subtract?
370. 372,656.
All right, so guys, that's how we account for an purchased tangible asset and internally generated intangible asset. Then when we meet next week, we're gonna start impairing these assets. But when we are doing impairment, we're also doing impairment. Remember, this is IS 38. We're also doing impairment of IS 16, right? We'll also be doing impairment. We've done the PPE, the physical one, they can also be impaired. We've done this one, they can also be impaired.